Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Thursday, May 9th, and we're talking about Berkshire Hathaway. I'm your host, Nick Sciple, and today I'm joined by Motley full contributor Matt Dilallo via Skype. How's it going, Matt?
Going well. How are you?
I am doing great. This Anadarko, Occidental Petroleum, Chevron deal, we just can't seem to get away from it. We talked about, last time we had you on the show, April 18th. Chevron had just made an offer to buy Anadarko. 12 days later, Warren Buffett and Berkshire Hathaway jumped into the mix. We're going to talk about that today. But then this morning, Chevron announced they're pulling out of the deal. So, every time we come on this show, we're getting new news, new stuff to talk about here with this deal. So, just the news of the day before we kind of dive in deep into kind of the details of this deal. What's kind of your thoughts on Chevron pulling out today, taking that $1 billion, breakup fee and kind of taking their ball and going home?
Yeah, I think that makes total sense for them. Even though the deal really looked good from a Chevron perspective, there's so much more strategic benefits to them than I think for Occidental. But, taking $1 billion is, I think anyone would take that, especially in the oil industry. Oil prices have been so volatile. This deal could really hamper Occidental in the long term. I did like something that Chevron CEO said. He said, winning in any environment doesn't mean winning at any cost. And so their ability to, look at the cost and say, this isn't worth overpaying for that, I think that makes a lot of sense for them.
Yeah, and $1 billion doesn't hurt either. So, just to kind of break down how things shook out, Chevron had offered a deal at $62 a share. But then Occidental came over the top and offered $76 a share with $59 of that in cash. Earlier this week, we got Anadarko's board kind of said that the Occidental bid was bigger, and then Chevron pulling out today. So as we sit today, this is where we're at. And, what really made this deal possible were a few moves that Occidental was able to make to kind of generate some cash. So kind of there are two deals there. We have the Berkshire deal, which we'll talk about. But first, let's talk about Total. They're going to divest $8.8 billion worth of assets in North Africa. And that's the Occidental had said they were going to divest $10 billion in assets to be able to make this Anadarko bid work. This gives them $8.8 billion of that. What should we kind of know about this deal? What does it mean for Total kind of take that position in North Africa and take these assets away from Anadarko?
Yeah, so it makes sense for Occidental to pawn these off on Total. They're not really big in international markets, especially in Africa. So it makes a lot of sense. The question I have is, there was really no bidding on this that we know of. It was kind of like, hey, could you take these off our hands? And $8.8 billion is a lot of money for this. It does take off the LNG project that Anadarko was working on in Mozambique. That could be a big deal for Total over the long run because LNG is just this huge, fast-growing market. China is consuming a lot of natural gas, so they need LNG. So, it makes a lot of sense for Total to pick that up. They want to be a bigger player in LNG and kind of rival Royal Dutch Shell. So I think it's a good deal on their side. I don't really think Occidental got full value for it, but that's, my opinion.
Yeah, it seems to be the case. It seemed that Occidental felt a little thirsty on this deal. They're making a lot of moves to kind of generate the cash to be able to make it happen. Going to the Berkshire side of this deal, Berkshire got really an incredible deal from Occidental as well. So Buffett committed $10 billion to a preferred stock investment in Occidental Petroleum with an 8% coupon. So that means Berkshire's going to be getting $800 million annually. Every year from this deal, which for an investment grade company is the high end of normal. So really favorable deal for Berkshire, as well as, he got a sweetener in the form of, warrants to purchase up to 80 million shares at $62.50 a share. So when you look at this deal, it's kind of same question. It appears very favorable for Berkshire. What does this mean for Occidental? What was the rationale behind this deal?
Yeah, so there's two main concerns from investors on this deal. One of them, though, is all the shares that they were going to issue to Anadarko, and that would have, if they issued more than 20%, they would have had a shareholder vote, and they were concerned that shareholders would vote the deal down, and there's been a lot of talk that now shareholders will vote out the board. So in order to get around that, they needed to offer more cash, and so that's where the asset sale in Africa, and then this thing from Buffett because there was concerns about the balance sheet. Now, Occidental has a great balance sheet, A-rated credit. However, they're taking on a lot of debt in this deal. They're assuming Anadarko's debt, and then they're paying all this cash. And so one of the ways to kind of get around that is to use preferred stock, which it's like common shares plus equity. So it's kind of got that 50-50 balance. So it doesn't like weigh down the balance sheet in the eyes of like credit rating agencies. So as a way to kind of get around that, but the price they're paying is really incredible. Some analysts thought they could have got 6% if they did this deal through the public markets. And then, there's no, it's perpetual. So Warren Buffett could conceivably get this, $800 million a year forever. And he got $50 million just for signing the contract, whether the deal went through or not. And then you throw in the dilution from the shares that he can get. That's how he made all that money back in the financial crisis. He invested in like Bank of America and just banked big bucks from that, those warrants. So I think he's coming out well ahead on this deal.
Yeah. Again, you look back at the financial crisis, you had folks who needed money quick. It's just in, uncertain times. And here it seemed that Occidental really wanted to get access to this cash quick so they could get over the top of Chevron's bid. And then somebody like Warren Buffett and Berkshire are one of the few people out there that have the capability. I mean, I think when you listen to Buffett talking over the weekend about the deal, the details of it, I want to say, he first heard wind of it on Friday and the deal was, closed on paper by Sunday. There's not a lot of folks out there that could have made that deal happen that quickly. And, the ability to do that allows Berkshire to extract some pretty favorable terms. And, this is a classic deal for Warren Buffett. I mean, it seems like there's not a lot of downside for them from this deal. Again, Occidental looked a little thirsty. You mentioned some investors. T. Rowe Price in particular said, hey, if this doesn't go to a vote, we're probably going to vote against your board of directors here. So, I can see it making a whole ton of sense. It does obviously make a whole ton of sense for Total and Berkshire here. We'll see how things play out for Occidental. Some question marks about how much they paid. With this kind of payment going forward in perpetuity, do you think this is going to restrict the flexibility of the business moving forward? Or how does this play out on now that this merger happens? What is this liability going to do to the company's ability to invest further into the future?
Yeah, it does a lot of things for the company. They've already said that they're going to slow down their growth rate. They're supposed to grow maybe at an 8 to 10% rate going forward. Now they're going to slow that down to 5. Now that's off a larger base. So there's a little bit of that, but they want to generate more free cash flow so that they can pay, Buffett and then pay down debt and things like that. But the structure of this preferred really hampers them. The way it works out is if they pay out more than $4 a share to their investors, which it would be like the dividend plus buybacks, and the current dividend is $3.12 a share, they have to redeem these preferreds at 110%. So like $10 billion plus another billion. So it hampers their ability to buy back stock. It hampers the ability to raise the dividend. So, and then, if oil prices crash, now Occidental, they can do very, very well at $40 a barrel. But, if oil prices did, sustain a long downturn, they could have to cut the dividend or things like that because they're paying so much for this. And so I really question this deal. I hope I'm wrong for their perspective. I know why they're doing it. The Permian Basin is just this phenomenal basin. They're picking up a lot more land. They should be able to get a lot more drilling, but it just seems like they were way aggressive.
Yeah, this feels a little thirsty, like I said before. We'll see. Mm-hmm. We'll see how things play out. The Permian has the chance to really drive a lot of upside, but time will tell. All right, Matt. So now I want to talk a little bit about Berkshire's earnings. First off, the numbers, when you see this net income number off the top, it's really eye-popping, $21.7 billion. But you need to take a little bit of that with a grain of salt. $15.1 billion of that is just mark to market on the equity portfolio. The S&P was up 13% during the first quarter. And obviously that provided a whole lot of ballast for Berkshire's equity portfolio. So when you back out to the core business, you're looking about $6.6 billion in net income. A lot of cash, but not quite what you're just going to see from that headline number. But as you dig into the Berkshire's actual operating businesses, Matt, what kind of stood out to you from this report, and what's going on in that part of Berkshire's universe?
I really liked the railroad earnings. The pre-tax earnings were up 10% to $1.7 billion. He benefited from higher rates per car and fuel surcharges, and that big boost came even though there was like really bad weather during the winter and flooding in the Midwest, so that hurt volumes, but they made all that up on pricing. We saw some other railroads do the same thing. Genesee and Wyoming, they reported really strong earnings, even though there was all this flooding and stuff. The big things were industrial and consumers, which, your oil, your construction materials. So that hinted at a really strong economy. The weaknesses were in coal and agriculture. So it was really good. It shows that investment in Burlington Northern is really paying off.
Yeah, and those railroads kind of fit what Warren Buffett has done in the past. He used to always invest in newspapers. Those are kind of little monopolies. You look at a railroad. We've talked about with pipelines before. Those are little monopolies too. You control those routes. They're not really building a lot of new railroads these days. So when folks need to move things around, they have to go to Berkshire or these other folks. And when the economy is doing well, it really works out for these railroads. I mean, we've talked in the past too about there's pipeline constraints as well, taking away oil from some of these plays. Railroads are a good substitute for that, and so that kind of explains some of where you might see that strong performance in that part of the business. Their utilities and energy also had a pretty good quarter as well, Matt. What did you see from that part of Berkshire's operating businesses?
Yeah, so utilities and earnings there, pre-tax was up 11% to like $500 million. So that was pretty good. But it was interesting. There's a lot of mixed results. They own several utilities, and Mid-American's probably their most famous ones. Earnings there doubled, but a lot of the other ones are up or down. So but that just shows the diversification of Buffett's energy portfolio. And then he had some other energy businesses, like he has pipelines and he has investments in renewables and regulated electricity transmission. Those were down. They reported a loss. So the diversification really helped him. He had just some really good assets out there, and those are performing well, and they're offsetting some weak areas. Yeah.
Again, that's what you get from Berkshire, this super diversified industrial conglomerate in areas where, regardless of how the economy is performing, some part of that business is going to be doing well. A lot of folks want to look at today with Berkshire is their cash on hand. So they've got $114 billion in cash on the balance sheet, at least, at the end of the most recent quarter. Berkshire has said they want to keep $20 billion in cash at all times. That means they've got $95 billion in usable cash on the balance sheet hanging out. Maybe if you want to say 85 now that this $10 billion contingent, loan or contingent, cash infusion to Occidental is going to take place. You got a lot of cash on hand, and Berkshire did buy back $1.7 billion in shares, during the first quarter of 2019, which is more than they bought in the whole second half of 2018. But still a lot of cash sitting around for Berkshire to go to work. Folks have been asking Buffett whether he's gonna buy back stock. What are your thoughts on? Are you looking for Warren to write a big check and write back a big chunk of stock, or what are your thoughts on kind of how they've kind of been slow playing these buybacks and rumors about them?
Yeah, I know he's threatened, so to speak, to buy back like $100 billion in shares. However, I think he'd much prefer to buy good businesses than to buy back stock. You can make more money by investing in a good business than buying back your own stock. That stock buybacks only work in certain circumstances, like if the stock's depressed. So, if we have a big market pull down and it's kind of drawn down this week with all the trade talk, collapse rumors. So that could, instigate Buffett to buy back more shares. However, I think he really wants to buy, a really good business, and they haven't been there because the market's been doing so well. So he's patient. It's a good lesson to all of us to just have cash on the sidelines and be patient. It does, drag in the near term, but in the long term, you get a good business at a good price, and that's how he's created so much value over the years.
Yeah, he's just talked about having that elephant gun, wanting to get that big, that big haul, a big acquisition. But he did mention, during the annual meeting over the weekend that it's just become more competitive as more private equity has come out in the market, and there's just a lot more people competing for these deals, bidding up the prices of these businesses that might be attractive to Berkshire. So it's just been very difficult for them to find deals that are compelling, a very compelling value for them. I mean, in an ideal world, Buffett wants to find the deal like we talked about on the first half of this show, where heck, I get 8% in perpetuity on a big old $10 billion slug of investment. That's what he's looking for. And, when conditions present themselves, he won't hesitate, like he did with the Occidental deal. Talking about acquisitions and, how you need to kind of time how you buy things. Another thing that, Buffett talked about at the meeting was the Kraft Heinz deal. And, he said that he just came out and said, hey, we overpaid for this deal. They're doing well operationally, but, if you pay too much, any deal can be a bad deal. So as you look at the Kraft Heinz deal and how that's fitting into Berkshire's portfolio, what are your thoughts on, how its role is going to continue as part of Berkshire? And, what are your thoughts on that deal just in a broad sense?
Well, that's a good example of a deal where you had two kind of big companies merging together, and there was questionable strategic sense at the time, because you have ketchup, merging with mac and cheese doesn't, seem to make sense. And it's not really a growth business. There's been a lot of changes with how people are eating. We're trying to eat more healthy, so we're not eating the packaged foods that you have with the Kraft business, and so that's weighing on that, that business, and they're not getting, the sales and the synergies and all that. So yeah, he overpaid, but he overpaid just because the business isn't growing, and that's kind of the risk with these big deals. Is they're trying to manufacture growth by doing big mergers, and I don't know what the turnaround strategy will be for Kraft Heinz, because they're going to need to get into more of these healthy food product businesses to kind of be successful going forward.
Yeah, and those brands just traditionally, in the consumer's mind are just not associated, with those types of, that segment of the market. So we'll have to see how things develop. It's a rare instance where Buffett comes out and says, "Hey, I made a mistake," but you have to respect that, right? I mean, I think everyone as an investor, you need to be, you're going to make mistakes, but to kind of recognize it, analyze where you went wrong, and kind of incorporate those lessons moving forward. I think, from what's well regarded as the best investor, maybe ever, is a good example for us. Is when you make mistakes, just own it and try to learn from your mistakes and not repeat them going forward. We haven't seen Berkshire's 13F yet of what new investments they've been making. We're expecting that on May 15th, but we did get a little bit of kernel of information over the weekend that a lot of folks have been buzzing about, and I kind of want to talk about it, maybe for a couple minutes here with you, Matt. And that's that Berkshire's investment managers, that's Todd Wexler and Ted Combs, one of those has reportedly been buying Amazon recently. When you see that, Berkshire Hathaway, Warren Buffett, this business that it has been the paragon of value investing, buying low PEs, all those sorts of things, moving into Amazon. Kind of what's your reaction to that? And, what's your reaction to Berkshire, kind of breaking the mold on what they've traditionally invested in?
Well, that kind of goes back to our early conversation about they have all this cash and they need to figure out how to invest it and how to invest it well. And there's just been this shift in the marketplace of old school companies just aren't performing well, but you have these new school companies like an Amazon that are just putting, retail out of business. So I think, you see the disruption there and the upside there. I know myself, it took me years to try to, pull the trigger on Amazon because it's just going up and up and up. And like, oh, I think I paid like $300 a share at the time. And it's like, I just had to do it. And now it's skyrocketed from there. And I'm glad. And this could be one of those similar situations. Amazon is a very volatile stock. So, I'm sure he'll have to answer questions at some time. Oh, why did you buy it at the high or something like that? But, Berkshire's really started to shift into technology lately, which has been something that, Buffett has kind of avoided, but that's just because that's where our world is heading. We're becoming a much more connected world, online retail is being such a big part of it. So I can see them doing more of these type of things in the future, and it'll just shift how value investors look for value and look at the total addressable market versus, where things are today.
Yeah, I think we're seeing an evolution, whether Buffett wants to admit it or not, or whether traditional value investors want to talk about it or not. But value as an analytical style is different than value on a PE basis, right? And so you can have a company like Amazon that has been by traditional metrics overvalued its entire history. Like you could go back from 1997 to it IPO'd to today, and by every traditional valuation metric, this is a company that is going to look overvalued on a PE basis. But from if you're looking at it from an analytical style, the valuation of the company today relative to the future cash flows it can deliver in the future, I think the market is starting to recognize that is another way to find value. Matt, before we go away, it's kind of it's always fun to talk about with Berkshire. They've got all this cash on hand. If you're sitting on this big $90 billion portfolio today, and you could deploy it anywhere, what would be the big elephant gun acquisition you'd be looking for? If you were king of Berkshire Hathaway for a day.
Because he's so into value, the one place that I see value, and I cover it every day, so it's kind of the only place that I look, is pipelines. They're trading at such cheap valuations, sometimes less than 9 times cash flow, like a Kinder Morgan. I think that's a 9 or 10 times cash flow, and he could buy something like that and still have some spending money and get a really good return because these are regulated assets. They throw up a ton of cash. There's growth there. So I could see him, and that was one of the initial things that they thought with the Anadarko deal, that maybe he was interested in Western Midstream, which was their MLP. So I could definitely see that being something that if he hasn't looked at yet, he should.
Yeah, I think that one would be really interesting. We've talked about Brookfield Asset Management, right? That's kind of like the Canadian Berkshire Hathaway. I'd love to see them make a run or make an investment in them, kind of partner up with that business. I think payments is something that Warren Buffett has always been involved with in a meaningful way. I mean, he's been invested in American Express for decades. Somebody like Square, would fit in really nicely with that portfolio. We'll have to watch and see. The 13F is coming out here in a couple of weeks. So I'm sure we'll have something to talk about there soon. Matt, thanks for coming on the show. Love having you on, as always.
All right. Thanks for having me.
Thanks so much. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Matt Dilallo, I'm Nick Sciple. Thanks for listening, and Fool on.